Hello everyone, welcome back to the channel. Today we're diving into a topic that could change your financial future, investing in index funds for long-term growth. If you're looking for a way to build wealth over time without getting lost in the complexities of the stock market, you're in the right place. So grab a cup of coffee, get comfortable, and let's explore how you can start investing in index funds. What are index funds? First off, let's break down what index funds actually are. An index fund is a type of mutual fund or exchange-traded fund, ETF, that aims to replicate the performance of a specific market index, like the S&P 500 or the Dow Jones Industrial Average. Essentially, when you invest in an index fund, you're buying a small piece of many companies all at once. This diversification helps reduce risk because you're not putting all your eggs in one basket. Why choose index funds? Now you might be wondering, why should I choose index funds over individual stocks or other investments? Here are a few compelling reasons. Diversification. Index funds hold a variety of stocks, which spreads risk. If one company underperforms, it's balanced out by the others that might be doing well. Low costs. Index funds typically have lower expense ratios compared to actively managed funds. This means more of your money stays invested, working for you. Simplicity. You don't need to be a financial expert to invest in index funds. They're straightforward, making it easier for beginners to get started. Historical performance. Over the long term, index funds have consistently outperformed many actively managed funds. History shows that trying to pick the next big stock often leads to disappointment. All right, let's talk about how you can get started with index funds. Here's a step-by-step guide to help you on your investment journey. Step 1. Set your financial goals. Before diving in, take a moment to think about your financial goals. Are you saving for retirement, a house, or your children's education? Having clear objectives will guide your investment strategy. Consider how much time you have until you need this money. The longer your timeline, the more aggressive you can be with your investments. Step 2. Create a budget. Next, it's essential to establish a budget for your investments. Determine how much money you can comfortably invest each month. This doesn't have to be a huge amount. Even small contributions can add up over time, thanks to the magic of compound interest. Step 3. Open an investment account. To invest in index funds, you'll need to open a brokerage account. Research different platforms to find one that suits your needs. Look for features like low fees, user-friendly interfaces, and robust educational resources. Many brokerages now offer commission-free trading on ETFs, making it even more affordable to start investing. Step 4. Choose the right index funds. Once your account is set up, it's time to choose the index funds you want to invest in. Consider starting with a broad market index fund like one that tracks the S&P 500. This gives you exposure to a large portion of the U.S. stock market. You might also explore international index funds or sector-specific funds, depending on your investment strategy. Step 5. Dollar cost averaging. Now that you've chosen your funds, consider implementing a strategy called dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. This method helps reduce the impact of volatility, as you'll be buying more shares when prices are low and fewer when they're high. Over time, this can lead to a lower average cost per share. Step 6. Stay the course. Investing is a long-term game, and it's crucial to stay committed. There will be ups and downs in the market, but history shows that the market tends to rise over time. Avoid the temptation to sell during downturns. Instead, focus on your long-term goals. Remember, investing in index funds is about playing the long game, not making quick profits. One of the most powerful concepts in investing is compounding. When you reinvest your dividends and allow your investments to grow, you're not just earning returns on your initial investment, you're also earning returns on your returns. This exponential growth can significantly boost your wealth over time. Let's look at a simple example. If you invest $1,000 at an annual return of 7% in 30 years, you could have over $7,600 thanks to compounding. Imagine what consistent contributions can do. This is why starting early is critical. The earlier you start, the more time your money has to grow. As you continue your investment journey, it's essential to stay informed. Keep up with financial news, read investment books, and engage with communities online. The more knowledge you gain, the more confident you'll feel in your decisions. That said, while it's crucial to stay informed, avoid getting caught up in the daily fluctuations of the market. Focus on your long-term strategy. Revisit your goals and investment mix periodically, perhaps once a year, to ensure you're on track. So there you have it. Investing in index funds can be a powerful way to achieve long-term growth. It's simple, cost-effective, and backed by historical performance. Remember to set your goals, stick to a budget, and remain committed to your investment strategy. The most important thing is to take that first step. Don't wait for the perfect moment to start investing. There's no such thing. The sooner you start, the more you can benefit from the power of compounding and the market's growth. If you found this video helpful, please give it a thumbs up and share it with anyone who might benefit from learning about index funds. Also, don't forget to subscribe for more financial tips and insights. Remember, your financial future is in your hands, and taking action today can lead to a brighter tomorrow. Thanks for watching, and I'll see you in the next video.